Good morning and welcome to our transfer pricing webinar series with a clear focus today of transfer pricing and year-end adjustment. My name is Jørgen Andersen. As you know, I have been around for many years, and this is probably the 36th years anniversary for transfer pricing adjustments at year-end. With me today, I have allied myself with a colleague, an esteemed colleague. So Dorte, if you give a short introduction to yourself.
My name is Dorte Hyam, and I work with Customs and VAT in the Indirect Tax Department, PwC. Done that for many years, so yes.
All right. But with that being said, let's get into it. Transfer pricing adjustments. We all know that these year-end is fairly complex. We are all a little bit stressed, and especially when we're working with transfer pricing, we have a rough time actually articulating and getting all the right data for making it possible for us to make those appropriate transfer pricing adjustments. They are intended to ensure that we have an accurate financial result, and it's typically defined by our transfer pricing policies and our intercompany agreements. However, our policies and our intercompany agreement may not always be as accurate or precise as one would like. That often makes it very difficult to just make the most appropriate transfer pricing adjustments. It is recommended to avoid to do these last-minute year-end adjustment or to minimize the size of these year-end adjustment, but nonetheless, we know they are there. We have also in Denmark now gained insight to transfer pricing documentation through the submission requirements. And part of that submission is actually the ability to provide an appropriate reconciliation between what we have put in our statutory accounts and how it relates to our transfer pricing documentation. So all of a sudden, we are very much interlinked, and it's so important that we actually know what it is that we are doing from a transfer pricing angle in relation to this year-end process. A third issue that really is triggering a lot of difficulties is what we could call mismanage of local losses. Those of us who drive a principal structure know that we have an intention to say we need to make sure that there is an appropriate and accurate profit at the end of the year. And we are doing then adjustments to get into that. However, we have local statutory accounts that may not necessarily arrive at the same results as we do for transfer pricing purposes. For transfer pricing, we are often using some sort of group accounting when we are trying to manage whether or not we have to do the appropriate adjustments. And we have to be very concise in this, but what that breaks into is actually how do that recognize or reconcile with the way we in practice are imposing those transfer pricing adjustments. A good example of that is in SEC, the Stock Exchange Committee's letters to US listed companies, and in particular one for Amazon that they issued recently. They're saying that a reference to the disclosure requirements, the proposed adjustment that they are suggesting relating to transfer pricing with regard to foreign subsidiaries, they had to please explain how and to historically consider transfer pricing when evaluating tax contingencies and the required tax contingency disclosures. That's a pretty harsh request to receive from the SEC. And the answer that Amazon provided is to say that as part of our quarterly close process, tax and accounting teams meet and evaluate any existing and new uncertain tax position, including those related to transfer pricing. Then they try to establish what is the reasonable possible that the total amount of income tax consistency and how it will impact and will significantly increase or decrease within that 12-month period for that relevant reporting date. So we are into the engine or the center of transfer pricing when we are trying to deal with these adjustments, because all of a sudden we have to adhere to the policies that we have decided upon. A fourth issue that really is coming up here at year end is that we often recognize that our intercompany agreements, in some instances, even are missing. But in most cases, we are not even sure that they are updated. One of the key things is actually, does our intercompany agreement allow us to conduct these transfer pricing adjustments at all? Or is it fixed? We all have been doing transactions with countries where they are very reluctant to see adjustments if those adjustments impose that we extract profit from the local territory. That goes for India, that goes for China, that goes for many more territories. So the ability to actually manage and monitor our transfer pricing is key. What we have also seen a lot when we're coming to these year-end adjustments is that we are basing it upon benchmark studies. And those benchmark studies are not always a fair reflection of reality or actuality. We often have a lack of data involved in the benchmark study, but oftentimes it's possible to come up with something that is much more credible than just applying a benchmark study that has many, many years in the back. We have all been through a corona period that, for better or worse, truly have impacted businesses all around, but therefore, because of the lack there is with benchmark studies, also have implied that how reliable or how credible are those benchmark studies now when we're trying to do our transfer pricing adjustments. So here again, we need to have a very critical eye in terms of what it is that we're doing. The next thing is to just say, but why? You're coming up with this, that we need to do our transfer pricing adjustments, that we need to be proactive about it, but why bother? Isn't this relatively simple, or isn't this something that everybody can adhere to one way or the other? Can't we just do these quick fixes given that it's the year end? Dorothy is going to come back to that in terms of how accurate we actually need to be when we are performing our adjustments. But as an old state-authorized public accountant, there is also these statutory implications that we need to be on top of in terms of what does transfer pricing adjustments actually mean for our inventory valuation? What does it mean in terms of our tax reporting? What does it mean in terms of IFRIC 23 when we are dealing with tax uncertainties? And there are numerous areas where these last-minute adjustments truly have a significant impact, where the SEC also have explained big concerns to US-listed companies, but I think this is a fair representation for most of us, is actually that typically our key controls when we are doing these transfer pricing adjustments are inadequate. We do not necessarily have the time or resources or the ability to make functional division when we are conducting these transfer pricing adjustments. And therefore they go through and they end up in the statutory accounts in a hurry, but makes it difficult perhaps to have a profound audit and control trail to justify why we did what we did. That in itself, again, can create new difficulties. So where do we see these issues? It's typically the industries that's concerned has to do with goods manufacturers, distributors, or whoever is extracting some sort of raw material from the ground or mining. The type of transactions where we're seeing these adjustments are mainly goods, to some degree services, but intangibles are also clear. And that's typical because our intangibles are based on some sort of royalty or cost sharing or otherwise that we are making use of intangibles that we have on both sides. The elements here are very, very difficult and often requires that we have a clear idea of what is the basis for computing our royalty. We may know our royalty rate based on benchmarking or based on a COP analysis or similar, but we do not know what is the turnover or net proceed that we have to calculate it on, because that is sort of awaiting that we get to the final number for the year end. So there, it's a matter of really playing the game of materiality, figuring out what do we do? Do we do a best estimate? Do we await actual figures? Or what is the most appropriate, given that we are typically talking about significant adjustments? Another key element in why we should bother is what do we do with these losses? If we have incurred losses, typically in subsidiaries with limited risk, what do we then do? Do we just by default and automatically fill them up, making sure that they have whatever that is benchmarked? Or do we actually troll through their P&L to make appropriate adjustments for cost that not reasonably would have been under a similar scheme had it been third parties? Another key element in why bother is not so typical in the principal structures, but in more operational structures where we have a bigger interaction between the subsidiaries. And that is actually figuring out who is the appropriate tested party, especially if you look at software companies where you may have managing and control of the R&D process located in many, many jurisdictions. There it can often be difficult to just point and say, well, we have an R&D agreement, and therefore by default, it is always a cost-plus environment, if the realities is somewhat different, that we in fact are controlling and managing this completely different. Another area for, say, why bother is business reorganizations and restructurings. A lot of companies are part of these business reorganizations and restructurings. It's a dynamic process we live in a very dynamic world. We need to figure out how quickly or how slow can we do integrations of new entities that we have acquired or disposed of, and what does that entail then when it comes to transfer pricing? Simple example is that if we are having management fee allocated to a number of companies, if we bring a new company on board, does that mean that everybody is now receiving a discount in terms of how much they should pay for the same service as they did last year? Should you maintain the same level of services and charge the same amount to the newcomer? Or are you in a situation where you basically need to reconfigure your whole system around management services because there may be an integration with the new entity that has been acquired? So really key focus areas for why we need to bother on this. Interest and our financing arrangement. 5 years ago, 4 years ago, even 3 years ago, interest was a no bother because we were living in a zero interest environment. nobody was paying a high interest. There was not really a certainty around why we should do X, Y, Z, etc. However, nowadays, interest plays a crucial role for all of us. Intercompany financing is still by far the biggest chain of money transfer around the globe. Therefore, it's important that we actually know what that interest means, because it may be that our capital structure is actually suffering from that we did not do anything about it during the heydays of zero interest. But now, all of a sudden, the capital structure of our subsidiaries may entail that we, in fact, do incur losses locally because the interest burden is all of a sudden overwhelming towards the profit level that we have indicated that they should be making. That all of a sudden raises questions around how do we get into FinCap issues? How do we refinance or restructure? Should we do something about dividend? Should we pick up dividends where it's possible? Should we refinance what we are doing? Should we convert some of the intercompany debt, etc.? And do we in fact have intercompany loan agreements in place that are useful in the current case? Oftentimes you find that in order not to be as proactive in relation to intercompany financing, that we are operating with fixed interest rates. Although that may be justified, it's extremely important that we are able to actually substantiate it and say that it's not just the interest rate we need to look at. We actually also need to ensure that terms and conditions are intended and followed through when it comes to transfer pricing. So again, why bother? There is a number of things that you need to consider, and we need to consider it now before we close the books. Exit tax and presence of permanent establishment and substance are also key areas for why bother. Permanent establishments is an area that we see tax authorities, not just in Denmark, but all around, is picking up in a significant rate. And a recent example in Denmark is that tax authorities are questioning, we can see that you have a payroll bureau who is withholding taxes to a number of employees, but we cannot see that those employees are linked to a CVR number. We cannot see that the transactions we have gathered from MasterCard and Eurocard is in fact related to some sort of business. So therefore, we deem that you do have a permanent establishment. Same sort of rhetoric is also what we find in Germany and in other European countries, that they are starting to identify and say, you do in fact have a permanent establishment. We, in part of our year-end process, need to think about how do we deal with that? How do we cope with the risk associated with that year-end process? Should this be seen as a potential uncertain tax position? Whatever can we do to justify the position? Saying, is it truly auxiliary and preparatory work that we are carrying out? Or is it something more? And how do we then appropriately deal with it? And how do we do the appropriate transfer pricing adjustment if we arrive at the conclusion that we do in fact have a permanent establishment and we do have to establish some sort of taxable presence and an income? We have talked about the inadequate transfer pricing documentation. We have also seen that taxpayers' transfer pricing documentation for the benchmarking is causing a lot of trouble when it comes to the year end. And we also know that tax authorities have a keen eye on what we call tax treaty shopping indicators. It's so very, very easy with all the relevant data points that we have out there for tax authorities to actually connect the dots and say, there seems to be something here. In Denmark, we are even privileged that we have had the key focus on the beneficial ownership cases. That again is indicating the length and the strength of these tax treaty indicators. So transfer pricing adjustments have always been focusing on valuation issues. It has been on hard to value intangibles. It has been on profit division with some compliance, and that's especially in the UK. It has been with our ability to have our master file and local file in place, bearing in mind that tax authorities are looking into that whole submission package that you're providing. It's the ability to provide a proper audit trail. And it can be all about how is VAT, GST in some jurisdictions, India for instance, how is that all interlinked? And that is perhaps a pretty good segue to say, what have we seen in Denmark in the most recent court cases? We've seen court cases on intercompany royalties, where the Danish Supreme Court ruled in favor of a taxpayer in a landmark case on intercompany royalties. The court held that there was no basis for the Danish tax authorities' royalty adjustment, setting aside previous ruling of the Danish National Tax Tribunal and High Court. So again, the ability to demonstrate that that you are able to justify your position if you have a robust transfer pricing policy to strengthen the arguments that you're providing in court cases. Transfer pricing documentation. During a transfer pricing audit, the Danish tax authority disqualified the transfer pricing documentation based on deemed flaws and made a discretionary tax assessment. That really is the key difficulty we do have in Denmark, is that the tax authorities often find themselves in a position where they can conduct these discretionary tax assessments. We all know that the submission requirements that we have is actually based upon the ability of especially the Attorney General to actually raise issues around, did we actually provide appropriate transfer pricing documentation in due time? And therefore, if we did not, then that we are in a position where they can make these discretionary assessments. And now we're coming back to our transfer pricing adjustment. We have loss-making positions where tax authorities have argued that the intercompany licensing arrangement did not adhere to the arm's length principle, including that the Danish taxpayer was in a loss-making position. The Danish tax authority or the courts arguing that no third party would ever pay a license if that would result in a loss position. You can be in agreement or in a disagreement on that set of facts, but nonetheless, it's what we see out there, and we do have these court cases around it. Marketing services. Tax authorities believe that the taxpayer should have been remunerated for deemed marketing services rendered to a Swiss parent company, which would net out any royalty deductions, effectively resulting in a zero royalty rate. Again, tax authorities looking at your documentation, looking at your adjustments, looking at your year end, coming to a conclusion to say, you should have had something. There is a missing transaction that you have not justified your position of. So again, coming back to how strong or how weak are we in presenting our case. Sanity check. Tax authorities presented a sanity check based on the transactional net margin method with the Danish taxpayer as the tested party and relied on the Danish resident companies as comparables. Again, a typical situation where it's unclear from the way we have been conducting our transfer pricing, who is actually the tested parties, and how do we justify that it's the appropriate tested party that we have on board. If it's not crystal clear, we are leaving the field open for the tax authorities to make these discretionary assessments. We also have court cases on the deductibility of business expense. the High Court agreed with the ministry that the taxpayer had failed to prove that the royalties were deductible business expense. That is critical, that if we cannot even justify that it's an appropriate business expense, what it is that we're doing for transfer pricing purposes. That then also boils back to how do we cope with that when we're doing these year-end adjustments. We need to make strong evidence that when we are conducting transfer pricing, that it is business expenses we are moving around within the group, or income for that matter. In terms of this discretionary assessment, the High Court of Eastern Denmark dealt in a harsh blow to the Danish Ministry of Taxation in the last ever transfer pricing case in Denmark, and you're probably all aware of the case against AP Møller, now Total, where they did a significant increase of the taxable income for the oil business for a number of previous years. So again, coming to these discretionary tax assessment. And what is troubling for someone like me, who has been in the field for many, many years, in relation to this case, is that there is very, very little substance that the tax authorities or the Supreme Court has actually based their decision on even how they arrive at their conclusion, but more importantly, how they arrived at the various values they were adjusting for. And that makes it troublesome. And again, takes you into the arena where you say you need to be better prepared. You need to ensure that we can at all times justify what it is that we're doing. And our new Danish transfer pricing requirement basically showcases that the complexity and evolving nature of transfer pricing disputes in Denmark is increasing significantly. All right, and if we then turn to and saying, but couldn't we just do these transfer pricing year-end adjustments and that fulfilling of our transfer pricing policy, couldn't we just do that in a small room all by ourselves, sitting and getting our Excel sheets to reconcile? And that is just not the truth. The key thing here is that we do actually have both VAT and especially customs issues that we need to adhere to.
Before we go to that, Jan, there are two questions for you. Any difference of topics seen depending if dealing with a country where OECD principles are prevailing or not?
It's a good question, because the whole notion that we are talking about here is based upon OECD. On top of that, you have the UN, and on top of that, you have a series of countries' homemade interpretation of what they believe is arm's length. And transfer pricing adjustments in Africa, in many parts of Asia, is creating an awful lot of difficulties, where it's, as in OECD countries, it can be relatively more straightforward. If you're looking to the US, where transfer pricing is a field of economists, it's often just a matter of making the appropriate adjustment in due course in order to have it reconciled and justified. But we are seeing more and more countries being very, very intense and focused on making sure that whatever we do as adjustments, that we can actually follow through and have those justifications in place.
Another one, what does tested party mean?
Yeah, that's another good question. A tested party basically means that when we are in a transfer pricing content, we are making sure that what we are doing is in fact arm's length. That's the key nature of any transactions that we're contemplating for transfer pricing purposes. And that means that we need to do some sort of comparability we need to come up with a comparability to say what we are doing when we're dealing with somebody internally for intercompany purposes is equivalent to what it is that we would be doing had it been with an external or had it been between two external parties, i.e. securing that arm's length principle. That's where the comparability analysis come into place. And as part of the comparability analysis, you need to identify who is the appropriate tested party that you are comparing yourself with, either for the specific transaction or for the entity or for whatever rhythm you're building into your transfer pricing adjustment. So the tested party is the one that you are holding your transaction up against.
And there's one regarding benchmark, but I think we will take it when you talk about benchmark after this.
Let's take it after that.
As Jørgen said, transfer pricing cannot stand alone, even though you think it. It might influence the VAT and customs. The challenge in between VAT and transfer pricing is that it's based on different principles and different rules. VAT is based on the price actually paid, where transfer pricing is more arm's length and market value. So the criteria for VAT is that there is a supply for consideration, and whether or not transfer pricing adjustment will influence the VAT is that there should be a direct link between the transfer pricing adjustment and the supply of goods and services. It should influence the price of these goods provided or services provided. We have a rule in the VAT legislation stating that if it's a transaction between related parties, then we do not use the price actually paid, but then it is a market value. But the main rule is that the price actually paid is the base for the VAT. So that's why it makes it difficult to sometimes to challenge, or it's challenged to have this cooperation between TP adjustments and VAT.
Yes, you simply said, you could say when we're talking about transfer pricing, we're typically approaching that appropriate market price or arm's length price from the top, and VAT and customs are typically trying to arrive at that market price from below, building up from the actual.
Yeah, we look at the exact
price.
Transaction and the value of that. I think the more challenging is the customs, because customs is a cost which is not deductible, and that the VAT is normally deductible for fully VAT taxable companies. So, but again, customs is also based on different rules and different objectives. The main rule in customs value is it is the transaction value, which is normally the invoice value. The transaction value can only be applied if between related parties if the relationship does not influence the price. And in order to document that it's a case that the price is set as on arm's length, we actually do use the transfer pricing documentation within the customs. Customs value is used for payment of the customs or calculating of the customs duties. So if a transfer pricing adjustments result in a higher price of the value of the goods and thus a higher customs value, then you need to pay more customs duty, and vice versa. If it's a lower price, then you are, some countries, allowed to apply for a customs refund. But it depends on the countries and the practice within those countries.
Yeah, and in supplement to what you're saying, Torte, that additional custom price that you in principle could be extracting or given or asked for a refund of is often ending up being a sunk cost because you cannot do anything about it. And that in principle is all of a sudden changing the profitability of your local entity. So you're creating sort of a downward spiral in terms of how transfer pricing adjustments are influencing the performance of the local entity.
Yeah, and again, in order for the transfer pricing adjustment will only influence the customs value if there's a direct link, or if it's direct link to the importation of goods. So if it cannot be linked directly to the goods, it cannot influence the customs value. The European Court of Justice has, in the Hamamatsu ruling, stated that if a correct customs value is determined at the time of importation, and it is a correct value based on the customs valuation rules, then a subsequent transfer pricing value or adjustment should not change the customs value. And that is about a new practice, because before this ruling, the main rule was that whenever there is a transfer pricing adjustment, you need to amend the customs value. So the Danish tax authorities, and I also know that Germany has actually changed their practice, stating that now the main rule is that a transfer pricing adjustment should not influence or change the customs value. But it is a specific assessment from case to case and from country to country. And we know that especially China is very restrict with their customs value. If you have decided on a customs value, then why change it? Why do you change the price of your goods? And US is also very keen to these adjustments on the customs value. So it is a specific assessment from country to country and from case to case. But when setting prices within companies, you need to look at both the customs valuation rules and the TP, and not just the TP rules. They can be rather expensive in some countries.
I fully agree, Dorte. And just to supplement, we are still very much involved in a case in Indonesia, where the fact is that we are having a loss-making entity locally, and that means we have to fill up the gap for tax purposes. That requires that the customs value should go somewhat down. And that again means that the customs authorities, even though they are sitting next to each other at the Indonesian tax authorities, are requiring that we should pay something more on customs. So net, we are ending up in a situation where, in order to be in compliance, both for corporate tax purposes and for customs purposes, it actually is turning out to be a gross cost on both sides.
I think there's a question for you, Jørn. In cases of missing intercompany agreements today, is there a major advantage of getting it in place in 2023, risking quality due to speed, or rather ensure getting it right and implementing during 24?
You will never ever get me to say that it's a good idea to get something done in a rush. That is not correct. Best solution, of course, would be to get it correct, but get it done in due course. The key thing is actually not necessarily that you do have it put on a piece of paper, but that you actually can point to what are the specifics that we have adhered to, and if that adhering to actually also do allow us to conduct transfer pricing adjustments. Often a field that is left out of intercompany agreements, but truly an important recommendation for some territories. In some territories, like China, it really does not matter because you are not allowed to do so, and there we need to look at other mechanics to manage our transfer pricing. All right. But again, turning a little bit to our benchmark studies, because we can see also on the themes of these tax court cases, and we can see on various audits that these benchmark studies are being brought up as sort of the issue that really can prevail in these tax court cases. So it's very, very important that we actually do know why it is that we are conducting our benchmarks the way we are doing, and that we are not just picking something off the shelf that is not a fair representation of what is the underlying business that we're trying to benchmark actually doing. So it's really literally starts with the selection of comparables. And one of the key things here, and a good notice that I have always kept in the back of my mind, is what Winston Churchill said, that there is a statistics, or there is lies, damn lies, and then as a third, there is statistics. And these statistics that we are creating for benchmarking purposes are extremely vulnerable for being manipulated and are not necessarily a fair reflection of what's the underlying business, but is more, and oftentimes, and a quick way of trying to address how do we come up with something that at least can justify just a little bit. The true difficulties around benchmarking is that the only thing that actually makes it survive is that it's difficult to come up with an alternative. So it's the least poor thing we can do when it comes to comparability. The strength is if we can do internal comparability, but when we have to do the benchmarking, we have to make proper care that we actually run it ordinarily, that we are not just assuming something and sort of arriving at quick conclusions without being able to document what has been the appropriate steps that we have taken. So that selection of comparables is not just by random that we do it. It has to be a due diligence that goes beyond to make sure that it actually is a fair reflection of what it is that we are trying to benchmark. Whether it's a specific transaction, whether it's an entity level that we are trying to benchmark, we need to be very diligent in our selection of comparables. It also has to do with data availability. There is limited volume of data if we are very quick. So if you wanted to ask for, say, let's do a quick benchmark this year just to make sure we do it in an appropriate way, there is this continuous slack of data. That means that if we wanted to do something up to date, we wouldn't have the right or the right level of data available to actually make that conclusion. When we have then done our comparability, gross or base analysis, we need to think about, do we need to do an appropriate adjustment? It could be adjustments for the capital structure. It could be adjustments into investments into inventory or to account receivables or other elements that are critical for actually making these two things being comparable. We also need to bearing in mind that benchmarking process is a dynamic process. And that's also the reason why you have seen the Danish tax authorities impose the requirement that you do your benchmark on a regular basis every third year, but that you do financial updates each and every year, just in order to make sure that whatever you identified as being comparable actually continues to be comparable. Because, again, benchmarking is very much the basis of subjectivity. And in order for subjectivity to actually prevail in tax courts, you need to put a lot of strength in justifying your process. Ensuring that reliability is also ensuring what are the years to be covered. Are we talking about multiple years? Are we talking about a single year? Is it a broad-based analysis if we're to have this principal structure where we're looking at it at an entity level, bearing in mind what Dorte just went through, that when we arrive at a resale minus 25 and we implement that in our master data, that actually have a direct link to what Dorte was talking about in terms of we need to have that price setting for each and every category of goods or services and how that then have VAT and customs implications. We need to make sure that we are on top of what is the transaction we're actually trying to be comparing ourselves to. Is it a bunch of transactions? Does it cover both a sale, sale of goods, a management service, an IT charge, or anything else? Or is this in a transaction in isolation? And then also, of course, being sure of what is the most appropriate transfer pricing method. And then we arrive at what is then our potential comparables. We should then make the adjustments that we talked about, and we should make sure we can actually extract an interpretation use of the data collected to really underline that this is in fact an arm's length remuneration. Avoid off-the-shelf benchmarking analysis. Tailored benchmarking analysis to the taxpayer's circumstances is clearly recommended. And make sure you keep the evidence of your process. That decision-making process, your selection criteria, your accept and reject matrix are extremely important here. So is there nothing you can do when we are coming this year end? And what we can see is that increasingly best in class is actually doing a much more proactive management of transfer pricing, both in order to ensure the appropriate transfer pricing adjustment at year end, but also reduce tension and VAT and customs. And what you can follow through on that is that we do have what we call a digital approach. We have been used to a world where we oftentimes are sitting in isolation in our tax department, doing an Excel file last minute. We may even be, if we are new to the company, we may have inherited an Excel sheet from our previous colleague that we then need to do these adjustments in. And that is just creating a nightmare for these transfer pricing adjustments, both in terms of relying on the data that you're building your transfer pricing adjustment on, but also your internal control processes before you actually are putting adjustments to the statutory accounts in the various entities in as a last-minute booking. So our approach to this is that we do make a very digital approach, and we're making sure that we are actually now starting to operate not just with aggregated data, but data that sort of mirrors the business overall. We extract the appropriate data, and we are then making the appropriate adjustments and are securing that it constantly is updated to constantly reflect what is actually the true and accurate data available that actually ties and reconciles with the statutory accounts and the way you're conducting your or your bookkeeping. And that is then presented in that way we're doing the adjustments in an integrated dashboard that allows you to follow through. So all of a sudden, that whole process I talked about is clearly defined and described, and everybody can see it and interlink to it. So with that, come to an end. And if there are any Q&As, we have attached a checklist that you will see when you get the slides sent over. So you can have that and use as a checklist throughout the year-end process. And it's intended to be a guidance or a help, but it does, of course, not cover all situations at all times. So if you do have any questions, then feel free to reach out to Dorte and I, or anybody else in the transfer pricing group. And then, if there are
one question regarding benchmark. How firm do we stand with a pan-European benchmark on transfer of goods? Can tax authorities challenge us with local benchmark? If we are within range of such a local benchmark, how do you see the development of application of local benchmark in Europe?
Pan-European benchmarks are great for setting a policy to give some guidance in terms of what you should do and not do. But we are getting to a world where it's critically important that you go beyond the pan-European benchmark. If you go to a country like Italy, they do require that you file your benchmark study, and they do require that you have done an appropriate diligence in terms of making sure that you have done whatever you can to identify as many local Italian entities that you are comparing yourself to. In that case, the pan-European sort of become the second line of defense, saying that if you cannot come up with appropriate local entities to compare yourself with, then it can go. And you see more and more countries actually being tuned in on that sort of thinking.
No more questions popping in.
All right.
So
then we have our next transfer pricing webinar on the 7th of February, which is going to be updates to the OECD guidelines that stem from Pillar 1 for the Amount B. And there, funny enough, some of the underlying issues here relate very much to how do we then do that benchmarking for that routine business that we're talking about. And with that being said...
No, two more questions just popped in.
Sorry.
So essentially we need to make 100 benchmark if we are in 100 countries.
Yeah, I wish I could just say yes to that if it was for my own business. But the reality is here, we also need to take care of that we are managing risk in the appropriate manner. So yes, we need to be aware of what are the local requirements. Where is it necessary that you actually do that, take that appropriate next step and making sure that you are in compliance also locally. And then in other territories where this may not be a pressure point, that we are sort of making sure we're doing other things to ensure we are in compliance.
And another one, in comparability analysis, are ranges being more narrow, or is there an understanding that the world is changing rapidly, hence changes can occur, meaning ranges move or enlarge?
And the good consultant answer here is that it all depends. It depends on what sort of transaction you're looking at. It depends on what sort of business you're in. And so there's no right answer. The narrower a range is, the less likelihood that you would be significantly challenged. The wider the range is, there is sort of free movement for tax authority to challenge you in terms of it, given that from an OECD perspective, we are always claiming that the whole range is arm's length.
On the point of tested party, do you mean that even if the Danish entity is more complex one, we must also look at Danish entity margins apart from overseas tested party?
No, you cannot. By default, you cannot benchmark a complex entity. Tax authorities, in some cases, have been successful in raising that point towards the taxpayer, and it's just devastating to see that whoever has been assisting and helping them have not pushed back on that fact, or at least not in any way or form, because it sort of goes without saying that you cannot benchmark something that's very complex.
No more.
All right. Then we wish you a Merry Christmas and a happy year end.